Real earnings, October 2021. Transmission of material in this release is embargoed until 8:30 a.m. Eastern, Wednesday, November 10, 2021. All employees. Real average hourly earnings for all employees decreased 0.5% from September to October, seasonally adjusted, the U.S. Bureau of Labor Statistics reported today. This result stems from an increase of 0.4% in average hourly earnings combined with an increase of 0.9% in the Consumer Price Index for all urban consumers, CPI-U. Real average weekly earnings decreased 0.9% over the month due to the change in real average hourly earnings combined with a decrease of 0.3% in the average workweek. Chart 1. Over the month change in real average hourly earnings for all employees, seasonally adjusted, October 2020 to October 2021. Production and non-supervisory employees. Real average hourly earnings for production and non-supervisory employees decreased 0.7% from September to October, seasonally adjusted. This result stems from a 0.4% increase in average hourly earnings combined with an increase of 1.1% in the Consumer Price Index for urban wage earners and clerical workers, CPI-U. Real average weekly earnings decreased 1.0% over the month due to the change in real average hourly earnings combined with a decrease of 0.3% in average weekly hours. Chart 2. Over the month change in real average hourly earnings for production and non-supervisory employees, seasonally adjusted, October 2020 to October 2021. From October 2020 to October 2021, real average hourly earnings decreased 1.1%, seasonally adjusted. The change in real average hourly earnings combined with a 0.3% decrease in the average workweek resulted in a 1.4% decrease in real average weekly earnings over this period. Real earnings for November 2021 is scheduled to be released on December 10, 2021 at 8:30 a.m. Eastern. Table A1. Current and real. Constant $19.82 to $19.84. Earnings for all employees on private non-farm payrolls, seasonally adjusted. Table A2. Current and real. Constant $19.82 to $19.84. Earnings for production and non-supervisory employees on private non-farm payrolls, seasonally adjusted. 1. Technical note. The earnings series presented in this release are derived from the Bureau of Labor Statistics Current Employment Statistics, CES, survey, a monthly establishment survey of employment, payroll, and hours. The deflators used for constant dollar earnings series presented in this release come from the Consumer Price Indexes program. The Consumer Price Index for all urban consumers, CPI-U, is used to deflate earnings for the All Employees series, while the Consumer Price Index for urban wage earners and clerical workers, CPI-W, is used to deflate earnings for the Production and Non-Supervisory Employees series. Seasonally adjusted data are used for estimates of percent change from the same month a year ago for current and constant average hourly and weekly earnings. Special techniques are applied to the CES hours and earnings data in the seasonal adjustment process to mitigate the effect of certain calendar-related fluctuations. Thus, over-the-year changes of these hours and earnings are best measured using seasonally adjusted series. A discussion of the calendar-related fluctuations in the hours and earnings data and the special techniques to remove them is available in the February 2004 issue of Employment and Earnings or at www.bls.gov/c/sesfltext.htm. Earnings series from the monthly establishment survey are estimated arithmetic averages, means, of the hourly and weekly earnings of all jobs in the private non-farm sector of the economy, as well as of all production and non-supervisory jobs in the private non-farm sector of the economy. Average hourly earnings estimates are derived by dividing the estimated industry payroll by the corresponding paid hours. Average weekly hours estimates are similarly derived by dividing estimated aggregate hours by the corresponding number of jobs. Average weekly earnings estimates are derived by multiplying the average hourly earnings and the average weekly hours estimates. This is equivalent to dividing the estimated payroll by the corresponding number of jobs. The weekly and hourly earnings estimates for aggregate industries, such as the total private sector averages printed in this release, are derived by summing the corresponding payroll, hours, and employment estimates of the component industries. As a result, each industry receives a weight in the published averages that corresponds to its current level of activity, employment or total hours. This further implies that fluctuations and varying trends in employment in high-wage versus low-wage industries as well as wage rate changes influence the earnings averages. There are several characteristics of the series presented in this release that limit their suitability for some types of economic analyses. 1. The denominator for the All-Employee Weekly Earnings series is the number of private non-farm jobs. Similarly, the denominator of the Production and Non-Supervisory Employee Weekly Earnings series is the number of private non-farm production and non-supervisory employee jobs. This number includes full-time and part-time jobs as well as the jobs held by multiple job holders in the private non-farm sector. These factors tend to result in weekly earnings averages significantly lower than the corresponding numbers for full-time jobs. 2. Annual earnings averages can differ significantly from the result obtained by multiplying average weekly earnings times 52 weeks. The difference may be due to factors such as turnovers and layoffs. 3. The series are the average earnings of all employees or all production and non-supervisory jobs, not the earnings average of typical jobs or jobs held by typical workers. Specifically, there are no adjustments for occupational, age, or schooling variations or for household type or location. Many studies have established the significance of these factors and that their impact varies over time. Seasonally adjusted data are preferred by some users for analyzing general earnings trends in the economy since they eliminate the effect of changes that normally occur at the same time and in about the same magnitude each year and, therefore, reveal the underlying trends and cyclical movements. Changes in average earnings may be due to seasonal changes in the proportion of workers in high-wage and low-wage industries or occupations or to seasonal changes in the amount of overtime work, and so on. For more information, see Thomas Gavitt, Measures of Change in Real Wages and Earnings, Monthly Labor Review, February 1972.